$1,000 to $10,000, that's only an 11% increase. I mean, 11% is kind of like a good month these days. So my point, and this is where you get into the frenzy stage. We're not there yet. We're getting closer, but all of a sudden it's going to go 8, 9, 10, 11, and those $1,000 chunks those $1,000 leaps are going to keep getting easier because they represent a smaller percentage. When you go from 20,000 to 21,000, that's only a 5% increase, which is a good week. So that's one of the ways you get there from the perspective of $3,800 an ounce or $3,700 an ounce, where we are now. $23,000 seems like, I mean, that's the far side of the moon. But actually, as you get closer to it, it gets really easy to see that kind of spike. So yeah, that's my forecast. Those are the reasons behind it, and they're not changing. If anything, they're getting stronger. Obviously, gold's been going up. It's up well over 200%, more like 250%, just in recent months. And you go back over longer time frames, it's a lot higher than that. We're in a major gold bull market. The point I make is that this is going to continue, and a lot of investors ask me, say, "Well, hey Jim, you said buy gold when it was $1,500. It's $3,700, kind of teasing around $3,800 an ounce right now. Did I miss the boat?" And my answer is, well, you missed $1,300 worth, but no, or sorry, $2,300 worth, but no, you did not miss the boat. This rally is really just getting started. There are three main drivers. The first one is central bank buying. Now, 2010 was the year of inflection, meaning from 1970 to 2010, central banks and finance ministries, basically official institutions, were net sellers of gold. Beginning in 2010, they became net buyers of gold. Now, different central banks involved, Switzerland, UK, Australia, Canada were all sellers, still are. The Swiss have stopped selling. Canada, I think, sold all their gold. Not saying I have a treasure chest, but I think I have more gold personally than the government of Canada. So those some of those countries are still sellers, or at least they've kind of dialed it down to zero. The buyers are new. They're Russia, China, India, Japan, believe it or not, Turkey, Iran. Iran's not transparent, but there's a whole set of buyers out there. Vietnam, for its size, is buying a lot of gold, and they continue to do so. Now, central banks, to be clear,
for decades, central banks were net sellers of gold, reducing reserves and favoring fiat currencies. That changed in 2010, when major powers like Russia, China, Turkey, and India became aggressive buyers. These purchases create a price floor as banks step in during dips to accumulate more reserves. Unlike speculators, central banks don't chase prices higher, they accumulate strategically. Today, over 25% of global gold demand comes from these official institutions, underscoring gold's role as a hedge against sanctions, currency wars, and declining trust in the U.S. dollar. This quiet accumulation signals a long-term transformation in the global financial order.
They're very savvy buyers. They're not going to drive the market a lot higher by themselves, and they don't want to. If you were a buyer, why would you want the price to go up a lot? You'd say, hey, I'm still buying, so I just as soon keep it low for a period of time. But what they do is they put a floor under the market. They buy the dips. I hate to use cliches, but they do buy the dips. They put in standing orders. Russia for a long time was sort of 10 tons a month. Put in the orders with dealers in London. They don't want to disrupt the market, et cetera. But if you're an investor in gold, if you're any an individual, everyday American, or hedge fund, or whatever, and you're interested, you have limited downside because the central banks are putting in a floor, but unlimited upside for reasons we'll talk about. So that's what I call an asymmetric trade. It's a very nice trade. The second reason is good old fashioned supply and demand. You learn in your first week of economics courses. Might be the only thing you learn that's really valuable the way they teach it these days. But global output has been flat around 4,000 metric tons per year. That's all the mining in the world for about 6 years. Now, I'm not saying peak gold. It hasn't gone down, but it hasn't gone up. Just a little bit around the edges, but not very much. Right around 4,000 metric tons a year. So if you have constant supply, which we have, and increasing demand, which we do, that means the price goes up. It's just, flat supply, increasing demand, price goes up. It's pretty much that simple. The third factor is that people say, gold's an inflation hedge. It can be an inflation hedge. The correlation between gold and inflation is less strong than most people assume. But I call gold the everything hedge, meaning, will it hedge inflation? Yeah, it actually hedges deflation. People don't understand.
Gold supply has stagnated at roughly 4,000 metric tons annually for more than 6 years. Mining exploration is slowed, new discoveries are scarce, and environmental restrictions tighten output. Meanwhile, demand continues to grow from central banks, retail investors, and institutions seeking stability in turbulent markets. With limited new supply entering circulation, every surge in demand intensifies the pressure on prices. This simple equation, flat supply, rising demand, drives the market higher. Analysts note that unlike tech stocks or fiat currencies, gold cannot be printed at will. Its scarcity is the backbone of its enduring value, ensuring upward momentum.
During the Great Depression, the best performing stock on the New York Stock Exchange was Homestake Mining, which was one of the largest mines in the world at the time. That's actually the foundation of the Hearst fortune, going back to George Hearst in the late 19th century. But I visited that mine. It's out in Lead, South Dakota. It's an open pit mine and an underground mine. They're not producing now. They produced up until around the year 2000, but certainly in the 1930s, one of the largest gold mines in the world. That stock went up at a time when the Dow Jones Industrial Index fell 82%. From October 1929 to June 1932, which was the bottom, almost 3 years, the stock market fell over 80%, but Homestake Mining went up, and it was the best performing stock on the New York Stock Exchange. Gold itself went up 75% during the Great Depression. It went from $20.67 an ounce to $35 an ounce, which, measured in dollars, that's a 7% increase during the greatest sustained period of deflation in U.S. history. So the history of the Great Depression says when stocks are crashing and deflation takes over, gold goes up significantly. So it hedges that. It also hedges inflation because, again, as we saw in the late 1970s, in 1979, 1980, inflation was 13, 15%. U.S. Treasury notes were yielding, 10-year maturity was yielding 15%. You could have bought a 10-year Treasury note that would pay you 15% a year for the next 10 years. But from 1971 to January 1980, gold went up 2,100%. So it hedges deflation, it hedges inflation, it hedges.
Gold is often labeled an inflation hedge, but history shows it's far more versatile. During the deflationary Great Depression, Homestake Mining shares skyrocketed while the Dow collapsed by 82%. In the inflationary 1970s, gold gained over 2,000% even as Treasury yields hit 15%. Beyond inflation and deflation, gold thrives amid crises, whether wars, banking failures, or political instability. This resilience makes it what experts call the everything hedge. In 2025, with global conflicts, debt crises, and rising geopolitical uncertainty, gold once again serves as a universal insurance policy trusted to preserve wealth when confidence in paper assets erodes.
Social unrest, natural disasters, civil wars, regular wars, et cetera, and uncertainty in general. So it's very good in that sense. And one last point, Jesse, and kind of why I see this continuing and getting to much higher levels. There's a little bit of math. I mean, you can do calculus if you want, but I try to keep it around the fifth grade level because there's no need to be more complicated than that. There's a behavioral psychological phenomenon called anchoring. And anchoring just means, we're all humans. We all have biases, which are usually a good thing. It kind of kept us alive for a couple million years. But an anchoring bias is you get a number in your head and it means something, and you anchor on it, and you kind of filter out other data around it. So people, obviously, who own gold look at price increases. And let's just take big chunks, $1,000. $1,000 an ounce is a lot. But, we've been seeing it go up $100 an ounce every couple of days for the past month or so. But let's just take bigger chunks, take $1,000. When you go from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. When you go from $3,000 an ounce to $4,000 an ounce, that's a 33% increase. And when you go from $4,000 an ounce to $5,000 an ounce, that's a 25% increase. The point is, there's still $1,000 leaps. And if you have 50 ounces of gold and it goes up $1,000 an ounce, you just made $50,000. And people think of it that way. They focus on the $1,000, or in my example, the $50,000 gain, and they're like, ka-ching, ka-ching, that's great. But what they don't realize right away, because they just don't think about it, each one of those $1,000 gains is easier than the one before, because it's the same $1,000 gain, but it's a smaller percentage gain because it's calculated off a higher base. So
one powerful force behind gold's climb is psychological, anchoring. Investors fixate on round numbers, $2,000 or $3,000, $5,000 per ounce. As prices climb in $1,000 increments, percentage gains shrink, making further leaps seem easier. For example, a move from $2,000 to $3,000 is a 50% gain, but from $9,000 to $10,000, it's only 11%. Each milestone encourages new waves of buying, accelerating momentum. This cycle fuels the potential for frenzy phases where prices climb rapidly. While $20,000 gold may sound like fantasy today, history shows that once momentum builds, psychological anchors make the unthinkable suddenly feel inevitable.
Going from $9,000 to $10,000, that's only an 11% increase. I mean, 11% is kind of like a good month these days. So my point, and this is where you get into the frenzy stage. We're not there yet. We're getting closer. But, all of a sudden it's going to go 8, 9, 10, 11. And those $1,000 chunks those $1,000 leaps are going to keep getting easier because they represent a smaller percentage. When you go from 20,000 to 21,000, that's only a 5% increase, which is a good week. So that's one of the ways you get there from the perspective of $3,800 an ounce or $3,700 an ounce, where we are now. $23,000 seems like, that's the far side of the moon. But actually, as you get closer to it, it gets really easy to see that kind of spike. So yeah, that's my forecast. Those are the reasons behind it, and they're not changing. If anything, they're getting stronger. I own gold, but I own silver too, and I recommend it. Silver is a little bit more difficult to analyze because, gold is not good for anything except money. So if you like money, have some gold. It's obviously a precious metal, but the industrial applications of gold are very few. Silver is different. Silver has a lot of industrial applications. But it is a precious metal. So you have to think of it as a precious metal money on the one hand, and industrial input on the other. Those can be moving in different directions. Obviously, the precious metal aspect is driving silver higher, but as we get into what looks more and more like an industrial recession, that could be a drag on silver use. But let's focus on the precious metal side. A couple of things about silver. Number one, it tends to lag gold. There's no way that gold's going to the levels I'm talking about, and silver is not going to go to $100 an ounce. If you see $20,000 gold, you're going to see $100 silver or more. But silver tends to lag a little bit. The gold takeoff happens and it makes all the headlines and people get spun up. And then silver just kind of sitting there like, what's wrong with silver? And then all of a sudden, silver starts to move. So I think you're exactly right, Jesse. We're in that mode right now.
While gold dominates headlines, silver is quietly preparing for its own breakout. Traditionally, silver lags gold before surging higher, often at a faster pace. With industrial uses in electronics, solar, and batteries, silver bridges two worlds: a monetary asset and a critical industrial metal. As gold rises, silver inevitably plays catch-up, potentially exceeding $100 an ounce. More practical than gold in everyday trade, silver also serves as a form of walking around money in crisis scenarios. For investors, silver is both a hedge and a utility, making it a compelling complement to gold in uncertain times.
But it plays catch-up. So silver could actually go up faster because it took longer to take off. So I think the way you described it is exactly right. But silver has a very important monetary use that I would say makes it even a little bit easier than gold, which is it's more practical. If you had a crisis and you had, where people lost confidence in money, or had electric grid breakdown, and we had to kind of use gold and silver to feed our families, so to speak. Silver is a lot more practical, because if you have a 1 ounce gold coin, let's say, okay, that's valuable. It's a form of money. It's bullion. But if it's worth $4,000 or $5,000, as we're describing, that's an awful lot of groceries. If you want to go out and get food for your family, a silver ounce or 5 silver ounces, which today would be $200, that's about the right amount of money to go shopping, in other words. So I recommend people have what's called a monster box. A monster box comes from the U.S. Treasury. It's the U.S. Mint, but of course the U.S. Mint is regulated by the U.S. Treasury. It's Treasury green, has a compression strap in it. Inside, in sleeves, plastic containers, are 500 1-ounce American silver eagles. They're pure silver, no alloy, beautiful design. But the point is, with 500 of them, that could be walking around money, as we say in Philadelphia. That could be spending money to feed your family, whereas gold will preserve value. By all means, have gold, very valuable form of property, but gold could almost be too expensive in terms of trying to spend it on the street. But silver, when I was a kid, even a young adult, we had silver dollars were common. At least be on your 21st birthday, some aunt or uncle would give you 21 silver dollars. It cost $21. Today that would be $800 worth of silver or more. As silver's taking off. It's lagging gold, but it's going to catch up. It's going to do very well, and it's also a very practical metal to have for basically spending purposes.